And I know we touched on it a little bit, the difference between that there are FHA and conventional, and there's also VA and possibly USDA in some of the more rural areas and that kind of thing. So what are the differences really between the loan types and that?
Well, we'll start with USDA. USDA is a loan designed for properties that are in outlying areas. USDA has maps that they've drawn up, and if the property falls within that map, then USDA will offer special financing. But it's a great program because the down payment requirement is 0. So
that's awesome.
And the interest rate's great, so it really is a great loan option for the right property and the right buyer. Another really great program for military veterans is the VA loan eligibility. And there are a lot of veterans out there that may not realize they have this eligibility, but if a veteran is looking to buy a house, the closing costs are very low for veterans because the VA protects them from paying a lot of the closing costs that most loans would offer, as well as they can finance 100% of the purchase price of the home. So again, the vet can get in with very little money out of pocket. They have very, very competitive interest rates on the veterans loans. The veteran loan does not have PMI or mortgage insurance, which is required on many of the other loans with minimum down. So that reduces their mortgage payments. So the VA loan is absolutely a fantastic opportunity for those who qualify for it.
And then when it comes to conventional, and I know that conventional is the kind of loan that has the Fannie and the Freddie guidelines. Is that what that is exactly, or what's a conventional loan?
Right. A conventional is probably the majority of loans done today. Basically, it's got a little stricter credit and income guidelines than, say, FHA or VA or USDA, but it is the preferred option. When you're putting minimum money down, FHA is a government-insured loan, so mortgage insurance is required on every FHA loan for life. Whereas with a conventional loan, if you put 20% down, you are not required to pay the PMI or the private mortgage insurance. And just so everybody knows, that's an insurance that protects a lender against the buyer's default on the loan. However, you can apply to have that PMI removed when you obtain the 80% equity in the property.
You know, how long does it take to get a loan?
We try and close all of our loans inside of 30 days. Key to that is getting everything in up front. The paperwork is the key to success with these loans. On every file in today's world, we're asking for tax returns, W-2s, bank statements, 30 days of pay stubs, a driver's license. If we can get all that information in up front, we can then get the file reviewed a lot faster and get the client to the closing table within a very short period of time.
And I know that there is a difference too, and that we talk to our clients about when you're actually making an offer on a property between being pre-approved and being pre-qualified. And I know at the Federal Savings Bank that you guys do offer pre-approvals, which is almost like all you have to do is have the house qualified because you as a person are qualified.
Correct. We, as a mortgage banker working for a Federal Savings Bank, we do offer pre-approval letters up front, and that is myself or a mortgage banker reviewing all the paperwork, making sure all the income meets the requirements, making sure the assets are there for closing, just reviewing the entire loan package. And once we have that review, we can then issue a pre-approval letter to make an offer on any house that you choose to buy.